But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Hey, good morning. Welcome back to the Junius Maltby channel as we take a look at today's current activity on the markets, metals, and a discussion on the overall market conditions and, the blame people are placing on the virus that seems to be going global. So we're going to take a look at a really interesting article that surprisingly comes to us from Bloomberg. And I also want to take a look at some gold supply concerns. We know there's supply shock taking place, a lot of supply diminishing, and extreme demand for precious metals right now at a level I've never seen. And so I want to share with you an example of just recently what I witnessed take place with some coins I was possibly interested in, being gold British sovereigns, because I think there's a very strong indicator there, and I came up with a fun little index that I'm going to now refer to here on the Junius Maltby channel. And that's going to be the Gold Sovereign Supply Index. But first, let's start here with looking at this. The Dow dropping, it was down 950 earlier, now it's down 800. But again, this is the very beginning. I think this is day one of the new quarter. And I think yesterday was the close, finishing off the worst quarter in history, if you all are aware of that. We talked about that in the live yesterday. So we're starting this quarter looking pretty brutal as well. All the numbers that were coming in, even though they've said, hey, we can't even look at numbers right now. They're going to be so chaotic as far as what the unemployment numbers are going to look like. There's estimates all over the place, anything from 15% to 40%. We're looking at the Fed having to do extreme measures in activity, or so they think they have to. We've got a president calling for a phase 2 stimulus, doubling what they've already thrown down. So tons of funny money is going to be finding its way into the economy, and once it's spent, we know what that will do to asset prices. But let's take a look at metals today. Obviously, we're still dealing with that problem of the margins and losses in equities, so these big institutions are dumping metals to cover those losses. Now, like I've reminded you guys in the past, just ignore it. You don't look at the day-to-day. So what? Gold's down $1. It's sitting up around $15.95.20. You got silver down just a hair, about 15 cents, still in the $14 range. Not a big deal. We looked at charts yesterday, specifically the gold chart. Do you remember that? Over the last 15 years, there were only 4 down years. It's still up like 8-9% this year. It's doing extremely well compared to any of the other indexes. It's better. It's just been doing better. The fact remains, if around 2 months ago, an individual had dumped every stock that they held and put 100% of that wealth into gold, they would be doing significantly better right now than if they had remained in those equity markets and in those other toxic assets. They all dropped. Gold didn't. Gold's still up for the year. Again, it's a long-term hold. It's a hedge. It's protection. It's insurance. It's everything. It's real money. It's sound money. It's the ultimate extinguisher of debt. We know that. Continuing. If any of you are familiar with this channel from any length of time, you know I've been a fan of Peter Schiff's work and followed him over the years, or over a decade. Now, looking at this, he refers oftentimes to the Fed's balance sheet. A lot of the talking heads on the financial networks will talk about the Fed's balance sheet. Well, this is over the course of time dating back to before 2008. You can see back in 2008, the crisis hit, they expanded their balance sheet, right? Boom, look at it pop there. Now, this comes directly from the Fed's website. Let's read what they have to say up top there. The Federal Reserve's balance sheet has expanded and contracted, mostly expanded, over time. During the 2007 to 2008 financial crisis and subsequent recession, total assets increased significantly from $870 billion in August of 2007 to $4.5 trillion in early 2015. Then, reflecting on the FOMC's balance sheet, normalization program that took place between October of 2017 and August of 2019, total assets declined to under 3.8 trillion, just barely. Beginning in September 2019, total assets started to increase. And remember, we started reporting on that in September. Remember the fall, the repo market. But look at it bounce there. It started going up, and then the economy hit the skids. When this disaster hit, look at it spike there dramatically. Now it's above the 5 trillion mark. So when they say that it expands and contracts over time, it's very little to no contraction anymore. They can't do it. And it seems to me they can only increase it. It's going to rise, and it's going to continue to rise. They're continuing to ask for more and more. And the economy at this point is addicted to the Fed. I know this is boring, my friends, and we're going to get to some articles and more fun stuff in a moment, but we have to take a look at this. Again, Schiff was right on this. They claimed back in the day they would contract this, they would not do this as often, and perhaps try to reduce the Fed's balance sheet. And they never have. They never will. Look at this chart here. This is just year to date. This is just 2020. It exploded. It was under 4.25 trillion, and now it's over 5.25 trillion, and it's increasing every single day, it seems. They're just continuing down this path. And the Fed's not alone in this. Every central bank in the world is doing the very same thing. And now we're looking at, this is just the last 3 months. Just the last 3 months. Again, we know what took place, what the backdrop is here, but it's just getting started. I see that parabolic rise there with the Fed increasing its balance sheets, and you can only assume that is going to continue. It almost looks like the contagion rate of the current virus. And I would imagine that this curve is going to follow that one for the time being. And the economy is showing no signs of healing or any true measure of hope going forward. I know there are some sectors adding jobs, but overall, it's falling apart. It's sinking. It's on fire. And we know the primary causations to this are the same things that they're doing now. The reason this conflagration is so disastrous is because of the bailout bubble and all the Fed activity last time. Every time they do this, they just blow bigger and bigger bubbles, and when they collapse, it just collapses with more force. So let's move on to the main event. If the virus hadn't caused the crash, something else would have. This is a key point we were making for the last 3 months. Absolutely true. The pandemic has exposed the vulnerabilities of a structurally unsound financial and economic system, the end of the Keynesian economic model of fractional reserve banking, and all that is involved with that universe of corruption and theft. So again, this article's from Bloomberg. We're just going to read it, then we'll talk about it, and then we'll move on to some more gold conversation. The COVID has already had a significant impact on the global economy, which will worsen if the outbreak and the shutdowns designed to contain it continue for very long. But it's only an accelerant. If not COVID-19, as the disease caused by the virus is known, something else would have started the conflagration. Shortfalls in revenue and cash flows caused by the shutdowns have simply exposed the vulnerabilities of a structurally unsound economic and financial system. Much like we brought up in the past, these instabilities exposed Ponzi schemes, such as what's happening in Comex and such as what Bernie Madoff was doing back in 2008. A fall in revenue is problematic, but manageable without debt. Unfortunately, in the aftermath of the 2008 crash, debt levels were increased rather than reduced, encouraged in part by low policy rates and the abundant liquidity engineered by central banks globally. Global debt as a percentage of GDP rose from around 250% in 2007 to 325% in 2019. Current debt levels are triple what they were in 1999. Businesses and households with declining or no income and high levels of borrowing now face an existential struggle to meet large financial commitments. A second problem is that in the everything bubble, asset prices were priced for perfection. Policymakers boosted the values of financial assets to increase economic activity via the wealth effect and to support borrowing to protect financial institutions. High asset prices reflected high leverage in the form of leveraged loans for private equity or structured investments such as collateralized loan obligations. Debt-financed share buybacks and distributions to shareholders inflated equity values by increasing earnings per share, but simultaneously raised corporate leverage. Toxic layers of debt were heavily exposed to significant revenue downturns. Third, the weaknesses of the banking system were ignored. Regulatory rollbacks and tolerance for large dividends and capital buybacks undermined steps to strengthen bank capital and liquidity. In Europe and many emerging markets, non-performing loans were not appropriately recognized. The growth of the shadow banking sector was not checked. The current problems in the interbank market, reflecting increased counterparty risk concerns, are testament to these missteps. Fourth, declines in trading liquidity were disregarded. In the search for returns, investors assumed liquidity risk, sometimes unwittingly. Redemption terms offered by investment funds to investors were inconsistent with their illiquid holdings. As traditional market makers reduced activity, market-following structures such as ETFs and algorithmic traders were relied on for liquidity. In a crisis, these entities are users rather than providers of liquidity, as the current inability to trade even modest parcels of many securities shows. In a parallel move, investors moved to private markets and unlisted securities, which are difficult to value or liquefy in anything other favorable markets. Gated funds, suspended redemptions, and concern about accuracy of valuations were always going to create problems in any financial disturbance. Finally, over the last decade, most economic actors did not build enough buffers against shocks. Corporations convinced that they could access cheap capital at will reduced shareholders' equity and increased refinancing risk. Households reduced savings and went into debt to consume and purchase houses. In the case of the economically disadvantaged, this was compounded by low wage growth, lack of employment, security, and inequality. In the United States, the Federal Reserve found that many would struggle to raise $400 in an emergency. $400. People can't even raise that. Government banks and central banks steadily eroded their war chests and weapons, leaving them with limited ability to deal with a major dislocation. Even the spread of COVID-19 reflects a lack of preparedness. Given the lengthy history of virulent pathogens from SARS to Ebola, countries should have expected some sort of global pandemic to hit sooner or later. Their struggles to cope now reflect the lack of cogent health policy, as well as diminished spending on health due variously to austerity policies and privatization. Of course, they never cut back anything on the military-industrial complex. No, that's 8 or 9% of the GDP. The U.S. is addicted to violence, and of course they always have to use it and have their their resource procurement goons, because that's what they are. Investors expecting a rapid recovery are trying to time markets and catch falling knives, but dealing with these deep-seated systemic flaws will require time. These guys are going to get cut to pieces. I actually love it. It's entertainment. I can't even tell you how entertaining it is to watch these guys in the stock pits getting annihilated. I hope the guys that are longing certain indexes are just being destroyed. I hope the bulls are getting trampled and the bears are eating them, mauling them. Given the state of public finances, it is unlikely that governments, especially heavily indebted ones, will be able to sustain the level of support required to keep economies in total lockdown for months. Deleveraging and clearing out financial excesses will be slow and may not be feasible even if the will to tackle the task is found. The long-term damage will be great. That is an understatement. Hysteresis refers to effects that persist after the initial causes are removed. The current crisis will compound persistent financial and economic weakness. structural damage to industry, employment, and public finances, and savings and consumption behaviors, which are difficult to foresee. While the COVID crisis will probably pass, our fragile economic and financial system will take longer to recover. Very well put. I think this is a very unbiased and logical, very articulate article, a very good piece on what we're discussing here. And to me, it truly validates, not my position, because I don't know anything, I'm an idiot, this really does validate the Austrian economists that are out there, that we read, that we peruse and see on all the different outlets, especially those like Peter Schiff. He was calling this, they blew this huge asset bubble. He has been often talking lately about the pin that popped it. And it just so happens, again, the virus is not the cause of this economic contraction. It was the pin that popped the bubble. It just exposed the weakness. It exposed the problems and all the flaws within it. And now, as it unravels, we're seeing just how bad it truly was. A lot of people knew. We knew it was under the surface. We knew how decaying it was. And we were waiting for a moment such as this, a tipping point. We started talking about and really seeing things showing weakness and problems just back in September. And you can see that. You saw that with the Fed balance sheet. We saw that when they were intervening with the repo markets there and the overnight lending and trying to get those banks to have some level of liquidity. And there was a problem. There was a problem in the fall, and then this hits, and boom, the whole thing starts to fall apart. Where's it going? Well, we just saw that closing discussion there. The long-term damage will be great, okay? Even if this illness ends today, this very hour, this very minute, the damage that it has brought upon it and the unraveling and just the loss, the economic problems that are going to come out of this are going to last far longer. I mean, the supply shocks alone are going to take quite some time to catch up. So that's that discussion. Again, the point of that was if this didn't cause it, something else would have. We knew it was coming. We knew this was going to happen. Now we see the balance sheets, all the central banks, the flood of money, the stimulus, the bailouts, all the fake freaking fiat. I mean, do you not see it? The M1, the M2, all the money, the balance. I mean, it really is something to discuss here. When I was looking up the Fed balance sheets, I actually went to their page to read about gold because I saw these commonly asked questions on the actual Fed page, and one of them was, does the Fed hold any gold, and is the dollar still backed by gold? And of course, they said it's not backed by gold anymore, and the Fed doesn't really own any gold; it just owns treasuries. But there's a whole description there on their page. Anyways, the point of it is they don't have any gold. There's no gold there. Nothing backs these currencies. They're just empty promises, and they're debt vehicles essentially. This is going to lead us to gold. Let's talk about the supply of gold. It's gone. It's gone. So I began looking for British sovereigns, circulated, possibly in some good condition, just because they are so low over spot. Oftentimes you can get British sovereigns for around $20 over spot. And we all know the gold content is 0.2354, so just under a quarter ounce of gold. And again, the spot price is what it is, and then the premium on them is very low. It's only 20 over usually. I've seen them as low as 15 over. So to me, they've always been a really good way to purchase gold. They're a beautiful coin. They've got a lot of cool history to them. I'm always curious, where the gold came from, especially if it's a 19th century sovereign. Where did they mine this? Where did they extract it? Where did it come from? They're a cool coin. So I began looking around, and I went to Provident, SD Bullion, JM Bullion, and lo and behold, even the newly minted ones are essentially unobtainable right now. They're completely out of stock. Everywhere I went, out of stock, notify me, out of stock, notify me. The only things that were in stock were a few half sovereigns. Even maple leafs were out of stock. The Canadian gold maple leafs, the quarter ounce maple leafs. A lot of these pages I went to, the vast majority of gold coins that I would be interested in are out of stock. There is just not a lot of physical out there. Now, I know there's some places right now where there is. I believe JM Bullion had some measure of gold buffaloes in stock, a few eagles you could get. And again, this was just me looking for sovereigns. So I wanted to start the Gold Sovereign Availability Index as an indicator of the gold supply or demand that the public is placing on physical gold. And I think this is a major indicator because they are a common coin. They're a very good way to get gold, to get it for not that much more than spot. So I think they're very appealing in that way, and that's why there's a demand for them. And the fact that they dried up, I mean, just the other day I went on, I can't recall exactly what page, it might have been Provident, and you could add to your cart, and it showed that they only had 300 or so left in stock. They had 300 or something sovereigns, and they're gone now. So again, I'd like to get a few sovereigns, but I can't. They're out of stock everywhere, completely out of stock. So again, the silver thing too, I went to a couple of pages. It looked like the 100-ounce silver bars were out of stock on every page I went to. You could not find silver in the large bars, or even some of the 10-ounce bars were out of stock on most of the pages. So we're seeing that. We're seeing metals supplies having an issue. And again, it's a very logical and clear and good reaction to what's taking place. I think it's just another indicator of what's going on, the overall toxicity of the markets, the world economy, and what's coming down the road. Because at the end of all of this increasing of balance sheets, all of this overspending by the government, the debt, what they're going to do is inflation and potentially hyperinflation, with currency wars really coming into play here in the coming years. The only way to protect yourself from that, with these currencies being destroyed, is going to be precious metals. So, yeah. Thanks for tuning in. Thanks for being part of the Junius Maltby channel. I hope this was a very good, boring episode for you. If it put you to sleep, great. If you enjoyed it, hit the thumbs up button. And if you like what's done here, and you like this channel, the content that it is, and you want to motivate this channel, feel free to support it. There's ways of doing that. We have Patreon. You've got all the links down below. You can explore those, check them out. We're always appreciating stuff like that. Even the super chat. A lot of you are very good about doing that, especially on the premieres or the lives. So I always appreciate any support offered for the channel, keeping it going. And thank you all for tuning in, as always.